Hello everyone and welcome back. Before we dive into today's market breakdown, I want to address something important for the silver community. We are officially launching our next silver giveaway, and this one is significantly larger than the last. This month, one person will receive 20 ounces of physical silver. Entering is simple. Like this video, subscribe to the channel, and leave a comment below. In your comment, either share your favorite form of silver or where you believe silver prices are headed in 2026. That's all it takes. The winner will be announced during a live broadcast at the end of January. Last month, we gave away 10 ounces. This time, we're doubling it. Now let's talk about why today's discussion actually matters. Silver is no longer behaving like a forgotten or ignored metal. What we're seeing right now is not random volatility, and it's not short-term speculation. The moves forming beneath the surface are structural. Something fundamental inside the financial system is shifting, and silver is reacting earlier than most assets. That brings us to the heart of today's conversation. My guest today is Bo Polney, an analyst known for studying market timing, historical cycles, and behavioral patterns. His work focuses on how markets move through repeating phases driven by liquidity, debt, and psychology rather than headlines. Whether or not you personally follow cycle analysis, there is one principle that cannot be ignored. Markets do not move in straight lines. They do not move randomly. Liquidity expands and contracts, confidence rises and falls, and when multiple cycles compress at the same time, price action becomes violent. That is exactly what we are seeing in silver. For more than 50 years, the global financial system has been built on credit expansion rather than sound money. Since the gold standard was abandoned in the early 1970s, currencies have relied entirely on trust. Debt exploded, leverage multiplied, and financial assets grew far beyond their real economic foundation. Gold and silver exist outside that structure. They are not liabilities. They are not promises. They cannot be created digitally. And that is precisely why they have always been viewed as inconvenient. And what becomes very clear in this discussion is that two systems are now colliding. On one side, there is a monetary framework that survives only through continuous liquidity creation. On the other side, there are physical metals that cannot be diluted, printed, or controlled indefinitely. This conflict is not new. We saw it in the 1970s when inflation destroyed confidence and precious metals surged. We saw it again in 1980 when silver ran too far, too fast, and the rules were abruptly changed. The same pattern repeated in 2011. Despite decades of intervention, silver never disappeared. It never lost relevance. It simply remained restrained. Fast forward to today. Global debt now exceeds $100 trillion. Derivatives are measured in the hundreds of trillions. Central banks are trapped. Rates cannot stay elevated without breaking the system, yet returning to zero destroys credibility. This is the backdrop against which silver is now moving. This is not hype. This is pressure. To understand what is unfolding, you have to understand how silver has been controlled for decades. This is not a free market in the traditional sense. Silver trades in two separate worlds simultaneously. One is the paper market, dominated by futures, options, and unallocated contracts. The other is the physical market, where actual metal must be delivered. Historically, price discovery has occurred almost entirely in the paper market, where silver can be sold and resold many times over without physical delivery. That system functioned as long as confidence remained high, and physical demand stayed manageable. But that balance is breaking. Physical demand is rising while trust in paper claims is eroding. When those two forces collide, control becomes unstable. For decades, volatility in silver was suppressed through leverage, margin changes, and liquidity withdrawal. The objective was never to eliminate silver rallies completely, but to prevent true price discovery. We saw this clearly in 1980 and again in 2011. Each time silver approached a critical level, the market mechanics were adjusted and price collapsed under forced liquidation. What makes today different is scale. Back then, interventions worked because the financial system still had room to expand. Today, it is saturated with debt. Each new intervention requires more distortion than the last, and each response weakens the structure further. This is where cycle analysis becomes relevant. The recent behavior in silver does not resemble speculative excess. It resembles a cycle completion. Years of consolidation, repeated suppression, and failed breakdowns built pressure. When a market is compressed for that long, the release is never orderly. We saw this during the recent breakout period. Liquidity was thin, participation was low, and for a brief window, silver moved without heavy resistance. Price surged through long-standing levels. Then came the response. Margins were adjusted, pressure was applied, price was pushed lower. But this time, something critical happened. Silver did not collapse. It held. That is not a small detail. When suppression works, price breaks decisively. When it fails, price consolidates at higher levels. That is exactly what silver is doing now. Former resistance has turned into support. Control is weakening. Another force driving this shift is the widening gap between paper claims and physical availability. Industrial demand continues to rise due to energy, electronics, and defense needs. At the same time, investment demand is increasing as confidence in fiat currencies deteriorates. You cannot satisfy both indefinitely with paper promises. Eventually, delivery matters. Each attempt to push silver lower now results in a stronger base forming underneath price. This is not bullish sentiment. This is observable market behavior. Meanwhile, broader financial markets remain complacent. Equities trade near highs. Volatility appears contained. But beneath the surface, stress is building. Liquidity is tightening. Debt servicing is becoming unsustainable. Precious metals are responding before other asset classes, just as they always have. Silver, in particular, is no longer lagging gold. On a percentage basis, it is outperforming. Historically, this only occurs during the strongest phases of precious metals cycles. Retail enthusiasm does not drive sustained outperformance. Structural repositioning does. Silver's uniqueness lies in its dual role. It is both a monetary metal and an industrial necessity. That makes it exceptionally sensitive to financial stress and real-world demand simultaneously. You can manage price temporarily, but you cannot eliminate demand. And you cannot create physical silver out of nothing. Volatility itself is another signal. After long periods of suppression, volatility does not return quietly. It expands violently. The sharp daily moves we are now seeing are symptoms of stress, not speculation. Markets transitioning from control to discovery behave this way. This does not mean silver will move in a straight line. Pullbacks will occur, shakeouts will happen. Volatility is a transfer mechanism. It moves metal from weak hands to strong hands. What makes this cycle different is that the usual release valves are failing. At this point, the conversation must move beyond short-term price targets. The real issue is what silver represents if it continues to break free. Silver is not just another commodity. It is a pressure gauge. And when financial systems strain, silver exposes it. If silver were irrelevant, it would not need to be restrained. If it were abundant, it would not be volatile. If it were unimportant, it would not attract this level of attention. The market is communicating something. Whether people choose to listen is another matter. From an investor's perspective, the critical question is not how high silver might go, but what it protects against: currency risk, policy failure, the erosion of purchasing power. Those risks do not disappear because markets are calm. They build quietly until they don't. As we move deeper into 2026, instability is unlikely to fade. Fiscal stress, geopolitical tension, and monetary distortion are not being resolved. They are being delayed. And delay always carries a cost. Silver reflects that cost in real time. So whether silver surges, consolidates, or shocks the market again, the message remains unchanged. The structure has shifted. The old playbook is losing effectiveness. Suppression no longer guarantees control. This is why moments like this matter. Not because they are exciting, but because they reveal truth. And once truth is exposed, it cannot be contained again. Let me know your thoughts. Do you view silver as a trade, a hedge, or long-term insurance? Where do you believe this cycle ultimately leads? Share your perspective in the comments. If you found this breakdown useful, make sure to like, share, and subscribe. We'll continue cutting through the noise and focusing on what actually matters.
Hello everyone and welcome back. Before we dive into today's market breakdown, I want to address something important for the silver community. We are officially launching our next silver giveaway, and this one is significantly larger than the last. This month, one person will receive 20 ounces of physical silver. Entering is simple: like the video, subscribe to the channel, and leaving comment below to my Money Made Simple channel. And your comments, it here share your favorite form of silver or where you believe silver price are headed in 2026. That's all it takes. The winner will be announced during a live broadcast at the end of January. Last month we give away 10 ounces. This time we are doubling it. Now let's talk about why today discussion actually matters. Silver is no longer behaving like a forgotten or ignored metal. What we are seeing right now is not random volatility, and it is not short term speculation. The moves forming beneath the surface are struggle. Something fundamental inside the financial system is shifting, and silver is reaching it earlier than most assessed. That brings you is the hearts of today conversation. My guest today is Boo Polny, any analyst now for studying market timing. So friends, like this video and subscribe my channel and below your comments. Thank you so